Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another edition of our Never a Dull Moment for the New Zealand Dollar Currency Report. I'm joined as usual by Dan Bell from HiFX. Welcome, Dan.
Thank you.
And look, obviously yesterday we had the Reserve Bank coming out with its latest musings on the official cash rate. Obviously unchanged at 2.5% as everyone expected. But Governor Alan Bollard had quite a bit to say about the New Zealand dollar. How has that gone down in the currency markets?
Yeah, so the RBNZ kept rates on hold at 2.5% yesterday morning, but in his statement, the Reserve Bank Governor mentioned the currency and said that it was effectively too high, and that they may look at monetary policy settings to weaken the currency if it continues to climb. So quite an interesting statement from the governor. Interesting to note, the New Zealand dollar actually rallied against the US dollar following that statement, but that was more to do with US dollar weakness than New Zealand dollar strength. But yeah, certainly opening up the door to use monetary policy to have an impact on the currency is something new. We know that the Reserve Bank has intervened in the New Zealand dollar back in 2007. But it's not something they generally do because naturally we just don't have the firepower to have a huge impact on the foreign exchange market, which is the largest market in the world, and to push back against a lot of the overseas investors and the other central banks out there who are undertaking their own sort of monetary policy settings and having a bigger impact on the global flows of world currencies and the like. So. Yeah, I think for now it's probably more jawboning than anything else, but we have seen the interest rate yield start to sort of push down a little bit, and perhaps that's going to have the desired effect in the long term.
And other than the possibility of the Reserve Bank actually getting in there, intervening, buying or selling New Zealand dollars, is there any other option in their current toolkit that people think they could or might be able to use to try and weaken the New Zealand dollar?
Well, they could start printing money, but I don't think that's going to happen. It's certainly not something that the Treasury or the Reserve Bank has talked about. I mean, the difficult thing is, the New Zealand dollar versus the US dollar is really impacted more by what's happening in the US and what's happening with US monetary policy. And as we know, the US interest rates are set at basically 0 to 0.25%. Their central bank has undertaken a number of rounds of different monetary policy measures, i.e. printing money. And the New Zealand dollar versus the US is held up recently over 80 despite falling commodity prices and what is still quite an uncertain global outlook. So yeah, I struggle to see how we can do a lot, certainly by talking about the potential to use monetary policy and cut the official cash rate. Yeah, I think that's probably as much as they'd be prepared to do at this stage.
And how's the trade-weighted index, the TWI, looking at the moment? Because that's obviously been a key factor in the past.
Mm-hmm. So it's still high by historical standards. If you look at the long-run average, we're still sitting, close to those highs that we saw back in 2007 when he intervened last time. But if you look at how the New Zealand dollar is tracking against some of the other major currencies, obviously we're still quite strong against the euro, still sitting around 61.5, which is high by any historical standard. Against the pound, we're still sitting up around 0.5, but against the Australian dollar, we've actually come off over the last 24 hours and we're trading back into the low 78s after trading almost to 80 cents. So Australia is our largest trading partner, so the fact that we continue to have a weaker currency against the Australian dollar is a good thing for our exporters. So the TWI is still high. But looking at what's happening in Europe and in the UK, for example, where their interest rates are still very, very low, and certainly no talk about tightening monetary policy settings there. Again, it's just difficult to see how the New Zealand dollar can really fall out of bed when you've got these other central banks prepared to keep these rates so low.
And obviously what we heard from another one of them this week, again in the Federal Reserve out of the US with the latest FOMC meeting, and no real surprises there?
No real surprises there. I mean, the actual FOMC statement itself, the US actually raised their forecast for their economy. So the Fed raised the forecast for the economy and dropped the forecast for the jobless rate. It was actually in the media conference following the announcement where the chairman, Ben Bernanke, commented that they would be prepared to use their balance sheet and undertake further quantitative easing if they need to. So that was that was a comment he made, and I think that's pretty much keeping to the script. I think if the US economy was to fall back into another recession, the US really just don't have any other choices. They can't drop interest rates any further. They're already zero bound, and the only option they have is to get the printing press out. And there's a lot of debate going on in the US and amongst the economic community about monetary policy in the US. There's some that think that he should continue to print because the US really hasn't, doesn't have the momentum, and others are saying, that it's a hiding to nothing and that it's not really having any meaningful impact. So it's an interesting debate and one that will continue to have a big impact on the currency this year. Naturally, if we hear from the US Central Bank at any stage this year again that they're going to be willing to print, then the New Zealand dollar will rally against the US, and that's just that's the fact of how it's playing out at the moment.
And looking ahead to next week, we've got the Reserve Bank of Australia with their latest interest rate decision on Tuesday. It seems to be that almost everyone is already factoring in a cut there.
Yeah, pretty much. I mean, Australia had their CPI number out this week, which came in much weaker than expected, and the Reserve Bank of Australia had mentioned in their most recent meeting that as long as inflation was starting to fall, then they would be prepared to cut interest rates. So on the 1st of May, that's next Tuesday, they were expected to cut the official cash rate there by 25 basis points from 4.25 down to 4%. And I mean, the interesting thing is that after the CPI number on Tuesday, the Australian dollar came under quite a bit of selling pressure, was down a cent or so against the US dollar. But by yesterday afternoon, it was actually higher than before the CPI release, and that's despite the fact that the market has really priced in a 100% chance of a rate cut from the RBA next week. So it goes to show you that the fundamentals in either the New Zealand or the Australian economy have very little impact on what's happening versus the US dollar. So we know that the Reserve Bank of Australia are going to cut interest rates and potentially cut again later in the year, but the Australian dollar is up over a cent from the lows that we had after the CPI number. And again, it continues to be expectations about US monetary policy that are driving that's driving the Australian dollar.
And over in the Eurozone, the troubled Eurozone, we have some central bank interest rate decisions due there as well next week.
Yep, so the European Central Bank announced monetary policy next week. They're not expected to change the official rate there, which is sitting at about 1%. Europe continues to be an issue, as we all know. It comes in and out of the headlines. Last week, obviously, Spain was back in the headlines. Their bond yields were pushing up. Overnight or this morning, we had Standard & Poor's downgrade the sovereign debt rating of Spain, which saw a bit of pressure on the euro, and actually saw the risk positive currencies like the New Zealand dollar and the Australian dollar under some pressure. So it just sort of highlights that the European sovereign debt crisis is far from over. We've got elections going on in France at the moment, and those should be finalised by next weekend, where Sarkozy is expected to lose, and there could be some uncertainty, political uncertainty, come into the European situation, given that France and Germany are the two sort of perhaps that could have some impact on the developments in Europe towards more fiscal unity. So that is going to be interesting to watch as well. France has also got a 10-year bond tender next week as well. So
another factor that will be watched closely.
Yeah, and the US actually announced their non-farm payrolls report next Friday night New Zealand time as well, which is always closely watched. We have seen a little bit of a pickup in the number of people receiving the benefit in the US, which had actually been falling, and obviously the non-farm payrolls report from last month wasn't as robust as the market was expecting. So if we continue to see weakness in the US employment situation, well, again, that could be negative for risk assets in the short term. overall will start to open up the door to potentially further quantitative easing from the US. So
all roads lead to QE.
damned if you do and
Yes.
damned if you don't. I mean, we might see a bit of short-term weakness in the New Zealand dollar. As we know, commodity prices continue to look quite soft. But if things get worse in the US, well, the printing press comes out and away we go. We'll continue to provide to find support against the US dollar on that front.
Well, thanks for that, Dan. That's Dan Bell from HiFX, and I'm Gareth Vaughan at interest.co.nz with another edition of our Never a Dull Moment for the New Zealand Dollar Report.